Let us clarify the situation precisely, because the sensational headlines and breathless news coverage dominating public discourse are obscuring the core economic reality unfolding in plain sight, when people encounter headlines claiming that Canada is abandoning the United States in favor of a sweeping trade agreement with China. The initial reaction is often emotional. Shock, disbelief, and even a sense of betrayal surface immediately. Many ask how a close partner, ally, and neighbor could seemingly turn its back on the world's largest economy. Yet this reaction is shaped less by economic understanding and more by a narrative we have been conditioned to accept for decades. To understand what is truly happening, we must step away from patriotic symbolism and political theater and instead examine the situation through the unemotional lens of how global capitalism actually functions. What we are witnessing is not a sudden rupture driven by sentiment, ideology, or hostility. It is a calculated structural realignment rooted in economic logic. This shift reveals far more about the declining gravitational pull of the American economic system than it does about Canadian loyalty or intentions. For generations, Americans have been told that the United States sits at the center of the global financial universe, and that other nations naturally orbit around it because they share American values, institutions, or ideals. This is a comforting story, but it is largely a myth. In capitalist systems, values are secondary. Profit, stability, access to markets, and long-term predictability are what determine alignment. In the real world of capital flows and industrial supply chains, countries do not maintain friendships, they pursue interests. Canada is doing exactly what a rational actor within a capitalist framework is supposed to do, evaluating risk, opportunity, and return, then positioning itself where growth is most sustainable. For much of the modern era, the United States was the only viable destination for that growth. Whether Canada, Mexico, or even major European economies, access to American capital, consumers, and stability made the U.S. market indispensable. That era, however, is drawing to a close. Canada's redirection toward Asia, and China in particular, is not an isolated event. It is a symptom of a deeper structural ailment within the American economic model itself. We are observing a significant transformation in the global economic hierarchy, one that has been developing for decades but is now accelerating. An economy cannot indefinitely survive on debt expansion, speculative finance, and industrialization while assuming the rest of the world will remain dependent on it. Other nations have been investing in physical infrastructure, productive capacity, and long-term industrial ecosystems. They have been cultivating consumer markets that rival or exceed those of the United States. Canada sees this reality clearly. From Canada's perspective, the American economy increasingly appears volatile, politically fragmented, and prone to abrupt policy reversals. Tariffs emerge and disappear depending on electoral cycles. Infrastructure projects are approved and then canceled. Trade agreements are renegotiated under threats rather than cooperation. In contrast, China, despite its internal contradictions and challenges, offers long-term contracts, state-backed financing, and massive demand for raw materials and energy. In a capitalist framework, this comparison matters far more than rhetoric about shared history. When commentators describe Canada's actions as betrayal, they are asking the wrong question. The more relevant inquiry is why the United States no longer represents the reliable and attractive partner it once was. This is not a story about Canadian disloyalty. It is a story about American economic deterioration and strategic complacency. The inability of American capitalism to maintain its productive base, infrastructure integrity, and policy consistency has consequences. This trade agreement is not merely symbolic, it is a signal that the era of unilateral economic dominance, where Washington dictated terms and Ottawa complied, is ending. This matters profoundly because it directly affects prices, currency stability, and the foundational architecture of the North American economic system that has underpinned prosperity for nearly a century. Many assume this is a temporary diplomatic dispute that will resolve itself quietly. That assumption is dangerously incorrect. What is occurring is a reallocation of capital and resources on a continental scale. Canada is one of the most resource-rich territories on the planet, possessing vast reserves of oil, natural gas, timber, agricultural output, and critical minerals. For generations, these resources flowed south to fuel American industry and consumption. If that flow shifts westward across the Pacific, the balance of supply and demand within the U.S. economy changes fundamentally. The consequences are not abstract. American workers are already confronting inflation, weakened supply chains, and rising costs exposed during the global health crisis. If America's closest trading partner concludes that its economic future lies elsewhere, U.S. leverage declines sharply. The ability to impose terms weakens. The illusion of control evaporates. What becomes visible instead is the fragility of an economic power that prioritized global military reach and financial engineering over domestic industrial resilience. Capitalism, by its nature, is indifferent to history and emotion. It flows toward profit, stability, and growth. If returns are higher in servicing a rising Asian middle class than a stagnant American one, capital will move accordingly. Trade agreements will follow investment, not the other way around. This is the internal logic of the system Americans are told to trust. The global market is now delivering its verdict, and Canada is responding rationally to it. That verdict should be deeply unsettling. It is also critical to understand that this shift did not occur overnight. It is the culmination of years of escalating trade conflicts, tariffs, and diplomatic coercion originating from Washington. The United States increasingly treated allies as subordinates, leveraging the dollar and access to markets as tools of discipline rather than partnership. Such tactics inevitably encourage diversification. China, meanwhile, pursued a patient, methodical strategy. While Washington argued over tariffs, Beijing invested in ports, railways, and logistics networks across Africa, Latin America, and Eurasia. Now those investments are reaching North America's doorstep. This is why anger directed at Canada misses the point. The correct focus should be on the corporate and political decisions within the United States that hollowed out domestic production and made America a risky partner. This agreement involves massive infrastructure development, energy transport systems, mineral extraction, and technological collaboration. It represents an integration of Canadian production with Asian demand on a scale that would have been unthinkable 2 decades ago. The United States struggles to respond because it lacks a coherent alternative strategy. American leadership has been consumed by cultural conflict and short-term political spectacle while ignoring structural global shifts. This is not merely a failure of individual politicians. It reflects a broader failure of the Western capitalist model to deliver consistent, long-term prosperity for its populations and partners. Discussions of defense, morality, and values dominate media cycles, but they obscure the financial core of the issue. This is about capital expansion, market access, and economic survival. Canada's economy, like all capitalist systems, requires growth. It cannot achieve that growth by remaining tethered to a slow, unpredictable U.S. market. Accepting this reality is uncomfortable, particularly for Americans accustomed to primacy, yet discomfort does not negate reality. The American economic order is receding, and this trade agreement is one more day to point confirming that shift. For working people, the implications are severe. A more competitive, fragmented global economy means higher prices, fewer guarantees, and increased instability. Preparation begins with understanding. Media distractions do not change the fact that this affects employment, savings, and local economies. The question is whether the United States adapts to a multipolar economic world or clings to an outdated illusion of supremacy. To grasp the significance fully, we must examine what the agreement actually entails. Beneath the headlines lies a detailed restructuring of trade flows. Canada has entered into a strategic commercial alignment with Beijing that reshapes the direction of its exports. This goes far beyond agriculture. It includes long-term commitments involving energy, critical minerals, and infrastructure development. Historically, Canadian oil and gas moved south through pipelines that tightly bound the two economies. This agreement reorients that system toward the Pacific. China's state-owned enterprises are investing directly in Canadian mining operations, particularly in lithium, cobalt, and nickel, materials essential to battery technology and electrification. This is not conventional trade. It is foreign direct investment that transfers partial ownership and control. Capital flows in, and guaranteed access to resources flows out. Resources once assumed to be available to American manufacturers are now contractually allocated elsewhere. This represents strategic exclusion. If Canadian lithium is legally committed to supply Chinese battery plants, it is unavailable to American facilities. The implications ripple outward. Understanding how this occurred requires acknowledging a pattern of imperial overconfidence. Across administrations, U.S. trade policy became erratic and inward-looking. NAFTA was dismantled and replaced, but trust was already damaged. Tariffs on Canadian metals were imposed under national security pretenses. Pipeline projects were approved, cancelled, and revived repeatedly. For investors, such inconsistency is intolerable. Capital abhors uncertainty. It will transact with adversaries if the terms are predictable. The United States ceased to be predictable. China capitalized on this gap by offering long-term certainty. Canada, caught between volatility and stability, made a pragmatic choice. For Canadian resource companies, this agreement breaks decades of dependency on a single buyer. When the United States was the dominant purchaser, it exercised pricing power. That leverage is gone. For Canadian workers, the picture is mixed. Employment opportunities increase, but asset inflation and housing pressures intensify. For Americans, the consequences are unavoidable. North American supply chains are deeply integrated. Disruption raises costs across industries, from automobiles to housing to food. This shift also threatens dollar dominance. Energy and commodities priced outside the dollar weaken global demand for U.S. currency. Reduced demand translates into diminished purchasing power. The hidden subsidy Americans enjoyed through reserve currency status erodes quietly but relentlessly. Institutions designed to manage global trade have been sidelined, replaced by power-based negotiations. The United States assumed others would accept subordinate status indefinitely. Canada's refusal is a psychological shock to an elite accustomed to issuing directives. Diplomatic scrambling cannot reverse capital flows already in motion. At its core, this moment exposes a divergence between global capital's priorities and American state interests. Capital seeks growth, and growth is concentrated in Asia. Without offering stability and infrastructure, the U.S. cannot compel investment to remain. The result is visible in rising costs, weakened supply reliability, and declining leverage for American producers and consumers alike. This is not abstract geopolitics. It is the price of wood, the cost of homes, the availability of machine parts. It is the unraveling of assumptions that underpinned North American prosperity. Systems rise and fall. What we are witnessing is not collapse in a dramatic sense, but erosion, steady, structural, and difficult to reverse, and this is only the beginning.